In this session, let us continue our discussion on techniques of risk analysis. In the last session, we discussed the concept of risk, uncertainties, and investment decision under uncertainties. While making investment decisions under uncertainties, certain risk analysis techniques are available to make the decisions. In the last session, we discussed four important risk analysis techniques, that is probability, variance, standard deviation, and coefficient of variation. Let us continue with these techniques. The next important technique of risk analysis used for investment decision under uncertainty is risk adjusted discount rate. In short, it is called as RADR technique. This method calls for adjusting the discount rate to reflect the degree of the risk of the project. The risk adjusted discount rate is based on the presumption that the investors expect or demand a higher rate of return on risky projects as compared to less risky projects. The rate requires determination of risk-free rates and risk premium rate. Risk-free rate is the rate at which the future cash inflows should be discounted. Risk premium rate is the extra return expected by the investor over the normal rate. It is a composite discount rate. It takes into account both time and risk factors. It is calculated as shown, where NPV indicates net present value, NCF indicates net cash flows, K indicates risk adjusted discount rate, that is risk free rate plus risk premium, and I indicates initial investment. Hence, summation NCF divided by 1 plus K whole raised to 2 minus I. Coming to the next technique, that is certainty equivalent. It is a guaranteed return that the management would accept rather than accepting a higher but uncertain return. This approach allows the decision maker to incorporate his or her utility function into the analysis. In this approach, a set of risk less cash flows are generated in place of original cash flows. Here, instead of original cash flows, a set of riskless cash flows will be generated. Certainty equivalent coefficient transforms expected values of uncertain flows into certain equivalent. When CEC ranges from 0 to 1. When CEC is 1, it means that cash flow is certain or management is neutral. When CEC is 0, it means that cash flow is uncertain management is at risk. The net present value is calculated as shown, where NCF at T is equal to net cash flow for year T without risk adjustment. Alpha T is equal to risk adjustment factor. K indicates risk-free rate and I indicates initial investment. Hence, summation alpha T into NCF at T divided by 1 plus K whole raised to 2 minus I. The next technique of risk analysis is sensitivity analysis. Sensitivity analysis is a modeling technique used in capital budgeting decisions, which is used to study the impact of the changes in the variables on the outcome of the project. Under sensitivity analysis, the project outcome is studied after taking into the change in only one variable. The more sensitive is the NPV, that is net present value, the more critical is that variable. So, it is the way of finding impact in the project's NPV for a given change in the one of the variables. The steps to be followed in sensitivity analysis is: first step is finding the variables, then establishing mathematical relationship among the variables, and the last step is to analyze the effect in the change on NPV. The next technique is scenario analysis. This analysis brings in the probabilities of change in key variables and also allows us to change more than one variable at a time. It is possible where some factors are changed positively and some factors are changed negatively. It examines the risk of investment to analyze the impact of alternative combinations of variables on project's NPV. The next and the last technique of our discussion is decision tree. A decision tree analysis is a graphic display of relationship between present decision and future events, future decisions and their consequences. It is a graphic display of various decision alternatives and the sequence of events as if they were branches of a tree. Hence the name decision tree. It depicts the sequence of decisions and their expected outcomes under each set of circumstances known as states of nature. The basic advantage of a tree diagram is that another act subsequent to the happening of each event may also be represented. Hence, these are the various techniques of risk analysis available to the investor. The firm has to look into its situation and select any of these techniques suitable to its situation. To sum up, we discussed the various risk analysis techniques used for investment decisions under uncertainties. There are various risk analysis techniques like probability, variance, standard deviation, coefficient of variation, risk adjusted discount rate, certainty equivalent approach, sensitivity analysis, scenario analysis, and decision tree. The pros and cons, or the positive and the negative points of all the methods, must be considered before opting them. For further reference, these books can be considered.